In this video I'm going to go through some charts on TradingView just to provide a contrast to MT4. Also I'm going to go through the steps step by step so you can see the rules very clearly, and then you can see some more examples as well. Okay, so we're on dollar yen 15-minute chart. There's one that's happened immediately. I'm not sure if you can see it yet. Corrective setup. Let's break it down step by step so it's more clear. As I've said in the previous videos, what we're looking for every time, we're looking for strength. And how do we see strength in the market? We need to find larger candles than normal. Ideally see multiple in a row. This one here just about makes that. So we're looking for these kind of sharp moves with bigger candles than normal. Then we're looking for a shallow pullback, which is step 2. A shallow pullback going, no more than 38 really, 38.2. An extension higher above this wave to here, and a correction down below the low of here. So we're looking for somewhere to get out for the bulk of our position, at least here. So that's kind of what we're looking at. Of course, we need to have our fibs for our exact entry. So we take our fib from the initial leg once we see that, and we don't want to see it go more than 38.2. As mentioned before, this is our rejection level. It's the first level above the AB. This level here, that is where the liquidity is. These key impulse legs, this is what we call this first one, is what we call an impulse leg. So this is sort of similar to Elliott waves, where you're taking legs in the market, you're taking wave, you're measuring that first wave, that A to B. The interesting things in the market happen when the market breaks those levels. When we break above highs, that's where you either get the breakout or the fake out, or it doesn't last. So this setup is kind of like a fake out, where we're looking to get in above here, and we're not looking for the whole move. We're looking for a correction below the original low. There is some strategies you can use and different trade management systems in terms of how you could take these setups and then scale out of them, which I will go over in a later video, in one of the next videos. But this video I'm just going to really just go over the rules so you can really understand it and really conceptualize it so that it's more clear to you. So yeah, step 1, finding that impulse leg. Step 2, looking for a 38 retracement. Step 3, we're looking to sell with a limit order. Once we've seen that this 8.2 has been respected, we want to have a limit order there, and we're going to have our stop above our 236 level or above our 0.382 level. The 0.382 level is going to give you a bit more room, which is going to increase your profitability. Your win rate is going to increase your win rate, but it's going to also decrease your risk to reward. So you need to weigh that up and what's better. I tend to normally have my stop above here, but depending on other factors of what's happening in the market, I might go, I'm going to give myself a bit more room. Or if it's a particularly volatile pair or product I'm trading, I'll give myself a bit more room. So we take a short position here. So we'd be entering in that candle as it comes through, because we're going to use limit orders. You might miss it. If you miss it, then you can use a market order, or you could use a stop order. If you suddenly see the chart and we're trading above it, you could put a stop below to catch it when it comes back. Or in this example, if you miss it even here, you could look at entering on the retest. But ideally we want our entries here, or you can enter below the 0 if you have a bit of a tighter stop, but it's better if you're going to enter at the rejection every time. So if we look at that, let's just narrow that down. So if we're taking a wider stop, this is a 15-minute chart, so that's not very many pips, 7 pips, but the risk to reward is all we care about. So yeah, we've got on here 2 to 1. That's if we're putting our stop. If we're putting our stop above the 38.2 to give us that ultimate room, just shy of 2 to 1. If we're going to take the more tighter stops, so in between the two levels, we're getting close to 3 to 1, which is good. it's good risk to reward. I mean, even 1.5 to 1 is still good if you have a win rate, over 75% or over 70%. This has quite a high win rate, so even with 1.5 to 1, you'll still be making profit, decent profit. In terms of risk that you want to be doing, obviously it really depends on what account you're trading. If you're trading your own funds, you're trading other people's funds. If you're trading your own account, a smaller account, your own personal funds, you might want to potentially risk a bit higher, and you risk somewhere between 3 and 5%. I'd say never risk more than 5%. That should be your maximum, even as a retail trader. Even if you've got a £1,000, £2,000 account, don't risk more than 5%. Keep that discipline at least, because you need to have that discipline. If you're trading a funded account, or you're trading with us, a funded account with us at CTI, maybe you want to be risking a bit more conservative, 0.3%, 0.5% max. And even 0.3%, if you're risking 0.3%, make 0.6%, you've only got to have 10 winners to hit that 6% target in the evaluation, and you've got 12 months to do it. And if you're a portfolio manager, then you've got no monthly target and you've got no time limit to hit your target. You just got to hit 10%. So even with 0.3% per trade, if you can pick up a few winners a week, maybe you have 3 winners and 1 loss, then you're gonna be doing all right, aren't you? You're gonna have a 1.8% gains and then a 0.3% loss, so you're gonna take home 1.5%. That's a 6% per month, which is very good. I'm not saying you're going to get 4 setups every week. Again, it's going to depend on what time frame. The important thing is the risk to reward. So the risk to reward is the same. So 0.3% can be 10 pips, 15 pips, or 0.3% could be a higher time frame setup, and it could be 200 pips stop. Obviously, the lower the time frame you are, the more setups you're going to be able to find in a shorter amount of time. So that's the key. Having that good risk to reward each time, and being disciplined with your entries. If you do, for example, miss the trade and you see it after it's happened, and you want to get in, below the 0 level, that's the next sort of level. You can think of each level as part of the range which you can trade around, and you can use for an entry. So I have done it before many times where I've missed it and then I've entered. I've entered below the high when we come back below that, and obviously your risk rewards can be tighter. You're not going to get the same risk reward, but you're still going to be collecting, however many pips. Well, this is a 15-minute on dollar yen, so it's not very volatile, but 10 pips. But it doesn't matter again about pips. So now we're looking at dollar index from a few weeks ago. I've just zoomed in so we can get an idea of this in sort of a real-time setup. So imagine this is real-time, bottomed out down here, and then we see some buyers come back in. So this is the first real bullish impulse leg that we've had for a while. So again, it's the same as before. So we've seen this leg occur, and then we've started to see some sellers come in. Very mild selling, but we've established that this might now be a swing point. So we're going to come here and we're going to measure our fib. Now, as the market goes on, we're waiting for at least 30.9. So we've got 30.9 now. So now we've got potential. So we might even put our order here. We might even put our order here now. Because remember, we're preempting that the market's going to go from here up to here. Now we keep going. We finally hit the 30.2. It's always better if it hits 30.2, but the 30.9 we can still just about trade off it. 30.2 is sort of the sweet spot. If it goes there, then it makes the setup have a higher chance of success, I'd say. When we start to form these ranges as well, like a tight trading range that we've got here, these are often nice because we know what happens in ranges. They always get taken out each side, and there's opportunities to buy and sell each side. So this also can help the setup. So as we move along, looking like we're finally going to break, and we've come and we've reacted. And use your price action as well. That's a nice candle, but we've been filled at that point, and we're rejecting that level. So we're short now. We've gone offside a little bit. If we add our short position again, just to make that a bit more clear, we're going to make that a bit tighter. So maybe we're going to take the midpoint, because that's what I normally do, targeting down back to 38.2. So we've got a bit offside, nearly hit our stop, but we're all good. So it does take a bit of time sometimes. Patience is key, but there we go, we got there in the end. Let's just spread that out. So there we go. We've made 40 pips and we've risked 18 pips on this trade example. And that's really it. I mean, we did even go even lower. But again, impulse, shallow retracement, wave higher, enter, get out of there, back at the 38.2. It's nice, simple. We know the majority of the time it's going to target this block, this order block, this consolidation range. That's where the market wants to go, and you see it will often come back, and then at this point you don't know, this can just be a correction and we're going to keep going higher, or this can continue going back to the bottom, as we did. We actually went to the bottom and we came to the rejection on the other side and exploded from there. The point is, these swing points are the key. This is where I want to trade. I want to trade around this. These are the points that the market deems important. Some news or some orders came through, or institutions were getting involved. I mean, this is on a small scale, and these candles aren't that big, but this is just a small example. They're still relatively big on a lower time frame. It's all about being relative, but these impulses are what I want to trade off. They're what I want to trade around. They're what I want to get active, because that's where the market is being active, and that's what the market cares about, is those impulse levels. That's what the market wants to trade off. As we saw, this one is still sort of valid. It's trading off the other side. So that's kind of the philosophy behind it as well.